Hello my fellow freedom builders and welcome back to the channel. Today we're gonna have a look at some airline stocks. I have picked up Delta Airlines here specifically, but we can have a look at a couple of the others because they're basically showing the same pattern. The big question is it time to buy the airlines? They have dropped quite significantly. If we look at Delta Airlines here, they topped out at around 50 up here and have been down at 35. So there's quite a significant 30% drop there. The question is, has the drop ended now, and are they actually at a point where it makes sense to buy the airlines if we are looking some years into the future? Now, the airlines have been in some trouble in 2020, of course. The COVID closed everything down, and as we can see, a company like Delta Airlines, they went from $47 billion in revenue, and that was cut down by 2/3 here. The operating profits, of course, went into negative, and there have been a lot of different after effects of that. However, they are slowly gaining speed again. We can see here on the earnings per share continuing here that they were up a bit in 21, and then now they are accelerating, and it seems like the estimates for 2023 here is actually coming through. So let us have a look at it, because when we are looking at what analysts say, I'm just looking in here at Seeking Alpha, we can see that some are fairly negative. Analyst rating of publication says sell, and some of them we can see here downgrading to a sell on amplified risk. I'll get back to that risk later on. If we're looking in here, they're saying don't focus on the negatives. So they are agreeing that there definitely are some negatives here. Why the steep plunge should excite buyers now, and some people even have a buy here, and Delta Airlines stocks a disastrous buy with upside. The reason why this was a disastrous buy was because this analyst that he recommended some buying up here somewhere. I actually think he actually recommended strong buys up here, and as you know, there is a big difference between a good buy and a good buy, and this was more of a good buy with a 30% plunge. However, we might actually be at a point where it could start to make sense to look into buying different airlines. First of all, if you're a technical analyst, then there's no doubt this is a very good strong downtrend. If you're looking at the TPI chart in here, we can see that the uptrend has been green for a while, and as you can see, you should not just buy when the long-term trend turns green and sell when it turns red, because you would have taken much of the downturn here as well. However, there was a triple buy here with the stock price being above the 10-week moving average here, and had you followed that up and sold when the weekly TPI turned red, you would have gotten out here or somewhere in here. So that is definitely exciting. That we had a triple green again here, but it was not above the moving average, so it was not really relevant. So you could have taken a very nice gain up here, definitely of about 30%. The question is, when it turns green again, should we start buying, or if you are a value investor, should you start buying? Let us have a look at the valuation chart. Because in here, we go down to 2 years again, we include the analyst estimates, and we can see that if the earnings are going up like they are predicting here, well, we are almost through with this 1 year here that goes from here to here, and this one seems to be getting the numbers right. And if we assume that they also have a 13% rise in year 2, well, then there is definitely some upside. Let me just go back into the summary for a quick while here and have a look at the operating margins, because that is something that is very important to look at. We can see that the revenue is climbing up, reaching some reasonable level like it was before in 19 here, and then it is growing slowly here. It's not a fast mover, definitely. But we can see that the margins are climbing up from 0.9 to 3.2, and they are expected to reach around between 6 and 8 over the next couple of years here, meaning we are actually returning to the numbers from 19. Some are estimating that it can actually climb up to 10 to 12. But let's just assume that it can go up here. That actually means that we could double or triple the numbers from here, which makes sense if we look at the earnings per share. Then that is a 3x and almost 4x here. So the earnings per share makes sense if the margins keep climbing. Now, will they keep climbing? Well, some of the reasons why some analysts are very skeptical over the airlines altogether, not just Delta Airlines, are several things. First of all, there are some salary issues. The union workers have been quite harsh, and there are definitely some expenses to salaries that are going up, so that can pressure the margins. Then, of course, there is the let's just have a quick look here. The US oil. It doesn't have to be US oil, but when the analysts made their articles, the oil was climbing up here, had a really long bull run here from down below. It went up 47%, and of course, running an airline company, you have the fuel as one of the major parts here. And it is impossible to predict exactly where oil is going. There is a war in Ukraine. Right now, the OPEC Plus is also annoying the Western countries somewhat, because they have some finite oil reserves. They know that at some point they will run out of oil, so they're trying to squeeze the most out of the oil. We can all understand that. But of course, that is a bit of annoying for us if we want to prevent, if we want not to go into a recession. Then we want the oil price to be low. We also want the oil price to be low because that pushes the inflation down, and so on and so forth. So right now we have seen a drop in the oil around 13% over the last week or so. There was a bit of a thing with Russia because they had a ban on export of certain fuels. There was some diesel, some gas, some crude products, and that was simply because their own citizen, Russia, all of a sudden couldn't get the gas and the diesel they needed. So they banned export of these products. However, that costed Russia $250 million per day, $1.75 billion per week. And in a situation where Russia is in desperate need of capital to run the war in Ukraine, well, then the ban has just been lifted. So it will be interesting to see where the oil is going. Just remember that the airlines that we're talking about here, they are, of course, buying their fuel on futures contracts. So it's not like their costs are dropping 30% in a week, or their expenses are rising 50% in a couple of months. Because they have secured the prices a bit out in the future. But of course it is something that affects them. So let's try and have a look at, because we can read all these analyses all day long, and it is a bit frustrating because they go from strong sell to buy to back to sell. So let's have a look and form our own opinion here. We look at the evaluation, and as I said, first we're looking at the next two earnings report, meaning the first one here at New Year, and then the next one up here. And they are in the price here. We have a PE of 7.5 with these rises here. We can see that the latest price earning was 16. We can also see it has been a lot higher over the last years, but if we take a reasonable look at it and just say, all right, the price earning could be at an 8. If the investors are willing to pay a price earning of 8, and if these gains in the earnings per share is holding through, well, then there is a good argument that the airlines could go up. Are they going to go up 66% over the next 5 quarters? Well, I doubt it a bit. Right now the trend is down. I want to see it first, and we are probably not getting in right at the bottom. However, let's try and play a bit around with the numbers, because let's say that they, from year 2, from New Year next year, could have a growth at, let's just say, 5% per year, and that we extrapolated this 3 years more into the future, then we would actually see an airline that is in about 4.5 years, something like that, would have gone up by 92.6%, meaning that is a yield to us at around 16% per year. Now, are they going up by 5% per year? Well, no one knows. So let's try and put that down to 0 and just assume, okay, they're really getting hit by the unions and margins and oil and stuff. So let's just say that the next 3 years, they're not growing the next 3 years after the analyst area here. The next 3 years, they're not growing their earnings at all. And let's say that they have the investors are only willing to pay, let's say 6 in price earning. That's way below now, and it is a growth that is way lower than expected. That would still give us 5% per year. And as you know, I'm perfectly aware that no one knows the future, and especially not 5 years into the future. But I do like looking at companies and playing around with the numbers and say, okay, what would actually happen if they lost 5% of their earnings per share here in 25, 26 and 27? Well, they would still turn a little profit if the investors were willing to pay a price earning that is half of the average the last 20 years. So that is what I really like to play around with. We can also go back to the 2-year and say, okay, they are estimating 225% earnings growth this year and 13% next year. That is what, roughly 100% on average per year. Let's play around with the numbers here and say, what if the PE would be 7.5 and the earnings average over the next 2 years would only be 100%. We are removing the analyst estimates here. Then we would actually still have a very decent profit. What if the earnings per year only were 50? That is way below what expected. We would still be close to a break even. So that is kind of how I evaluate if something is good value, because good value is really a very vague subject here or topic here. So what we're looking at here is basically there are some estimates, but we know that the analyst can be completely wrong once in a while. So what if we take a lot out of the estimates? What if we reduce them by 20%? What about 30? What about 40%? What if we bring the price earning that the investors are willing to pay? What if we bring that down? And if we can see that we can both bring the earnings down and the risk the investors are willing to take, or the price earning they're willing to pay, if we can bring that way down and we still have something very close to a break even, well, then I'm actually not too nervous about buying a stock. Would I buy it right now? Well, no, because I do like to see the trend tipping up a bit. But if you are a hardcore value investor and you say, okay, I don't need an uptrend, I'll simply just buy it at some point, well, then you could consider buying it. Remember, this is not a buy recommendation because you need to use your own strategies and risk management and so on. And it can drop to 25 or 20 from here. I have absolutely no idea. But what I'm saying is that looking at the valuation, it kind of makes sense soon to start looking at the airlines. We have the same picture in United Airlines and several of the other airlines, but I won't bore you with them today because the graphs are basically looking the same. So this is my take on the airlines. Have a look at them for yourself. You can look at all the of course the summary of the earnings and everything down here, but we also have all the income statements, cash flow statements, balance sheet you need here. So yeah, have a look at it, decide for yourself, and see if airlines should have some sort of place in your portfolio in the coming future. That's all for now. Take care of yourself and your money out there. Speak to you again shortly. Bye.